I would always get the question, when's the recession starting? This is the sort of intense slowdown you get ahead of a recession. The economy is weakening precipitously. I think generative AI is probably going to be, it is a disruptor. There's going to be job destruction. Interest expense is a big problem. The interest to revenue ratio, if we get towards 30%, a lot of bad things are going to happen. We will get shocked into a fiscal crisis. And the way it's going, it could happen in a couple of years. The Joe Biden fiscal policy has been a train wreck.
What would you do if you were in charge? I mean, what would you do in front of this to prevent that?
The really big issue is entitlements. How can you be a capitalist country and have entitlements? What are you entitled to? We have to attack Medicare. You have to raise retirement age for benefits. We have to attack principally Social Security. Americans, just like Canadians in the 80s, Americans, they want their cake and they want to eat it too. Everybody wants the candy, but they don't want to pay for it. I'd have to just say the painful truth. We cannot afford the social contract. We have to break it.
David Rosenberg was a chief North American economist at Merrill Lynch during the 2008 global financial crisis. Many believe now, with more than $34 trillion in national debt, the U.S. is facing yet another financial crisis much bigger than the GFC. Only this time, many believe the U.S. could be losing its superpower as countries like the BRICS are joining forces to potentially reduce the world's dependency on the U.S. dollar, which has been the world's main reserve currency since the end of World War II. Now, with Americans deep in consumer debt, we're now asking, how will this potential crisis play out? Will the stock market collapse? Will the housing market crash? Will Americans lose their jobs? Or much worse, will all three of these things happen at the same time? David Rosenberg is now president and chief economist and strategist of his own company, Rosenberg Research and Associates. And in this interview, we discuss potential scenarios, and you can decide for yourself if you should be concerned and what actions you should be taking, if any, to protect your financial assets. I hope you enjoy the show. David, thank you so much for coming on the Sachs Realty podcast. You know, I enjoy listening to you on some of my favorite podcast shows, actually. And sir, I'm honored to share the screen with you today. So welcome.
Thanks very much. I just hope it's not a case of misery-loving company.
Well, I don't know. It's pretty easy to, you know, one of the most recent podcasts that I watched with you, you were talking about, you know, they asked you a question about something about being a perma bear or whatever. You know, it's crazy that people are in such denial about the actual state of affairs in our economy. So I'm going to enjoy unpacking this with you. But I just want to start with, because out of every show that I've watched with you in it, I never hear you talk about like David Rosenberg, like as a child, you know, what it was like to, you know, for you growing up, and, you know, who your influencers were. And really, I'm just kind of curious along with that is, how did you choose the path that, you know, that you're on in finance?
Well, what a lot of people don't know is that when I was in high school in grade 11, I took economics. And I remember after my first day, my father said to me, "So how was your first day in economics?" And I said, "Well, you know, we learned about the classic Keynesian model that assumes a closed economy and no government." So he said to me, "No government?" He says, "Son, I'm going to show you something." And he showed me his paycheck, where 50% of it went to the government in taxes. So he said, maybe you should think about taking something more practical. So I dropped economics, believe it or not, in high school. And then when I went to the University of Toronto in 1979, I didn't enroll in economics. I enrolled in the Bachelor's of Commerce program because I thought I wanted to be an accountant. And of course, economists are like accountants, except we have much better personalities. And in first year, at the University of Toronto, I'm doing great in every single course, except the one that I think you'd want to excel in if you want to be an accountant. And I was failing financial accounting. Managerial accounting, no problem. Computer science, calculus, all the rest of it. Financial accounting. And I remember that it was in December after the winter midterms, and I did probably the bottom of the class. And I go to my professor, Mr. Lee, and I said, Mr. Lee, like, what's going on here? And he says, well, you're having trouble, Dave, with the T accounts. You can't balance the T accounts for whatever reason. I said, yeah. I said, I've got this mental block. I can't seem to balance the books. So I said, Professor Lee, what do you recommend for your students who don't know how to balance the books? He says, oh, I tell them the same thing I'm going to tell you. I said, what? He says, go to economics. So I did.
Wow. So what was your career like? I mean, when you graduated college, what did you end up doing?
Well, because I was a teaching assistant at the university in the specialized course on real estate economics, I ended up getting my very first job in 1984 in Ottawa, where I grew up, at the Canada Mortgage and Housing Corporation, which is like the equivalent of Fannie Mae in Canada. So from 84 to 87, I did cost-benefit analysis on government housing policy. And so I was a housing guru, but I knew that government was not going to be in my future. It was very static and wasn't very entrepreneurial. And people showed up at 9 and left at 4. And I always had a lot of energy and a lot of passion. And it was a very bureaucratic environment. I mean, I learned a great deal there. But I applied back for jobs on Bay Street in Toronto, and I got hired by the Bank of Nova Scotia. I actually took a step back because by the time I finished at Canada Mortgage and Housing, after being there for 3 years, I had been promoted to senior housing analyst. And the Bank of Nova Scotia on Bay Street gave me the job of intermediate financial economist. And I said, I don't know about this. I'm senior in Ottawa, intermediate in Toronto. They said, yeah. They said, well, intermediate in Toronto is the same as senior in Ottawa. So just be happy that we're offering you the job. I said, okay, where do I sign?
Wow.
At my first day on the job, and this has stuck with me to this day. This might explain why I've got this dark cloud wherever I go, why I'm Eeyore the donkey. Was my first day as a street economist was October 19th, 1987. And I'll say to you that if you started your career on the street on the same day of a 23% collapse in the stock market, you might walk around with a dark cloud over your head constantly as well. So that was my start.
Yeah, wow. Well, now with decades of experience, you're kind of looking at, we might be on the cusp of another collapse. So, I mean, what do you think, where do you think we are here in the States? I want to kind of talk about from a global economic, standpoint and touch a little bit on, the stock market and the financial markets, the U.S. financial markets, and really, I want to tie it into politics a little bit here today and geopolitical issues because I am thinking that a lot of what we're hearing in headline news is inaccurate. And matter of fact, I know it is. But based on your work now with Rosenberg Research, I mean, what do you think of the U.S. economy? Well, let me start by saying this. What has changed with your thoughts with the U.S. economy after this assassination attempt on Trump?
Well, the assassination attempt on Trump, how do I view that? Well, I can't really put a macro call on that. I think what you would do is probably connect some dots and say that Trump probably gets a sympathy vote out of it. Much like Reagan did in 1981, except back then we were 3 years away from an election, and now we're just a couple of months away. So And I expect that Trump, say, gets a lift out of it. And then I'm figuring that everybody's toning down the rhetoric, and the White House primarily was formulating their campaign around, attacking Trump as some authoritarian figure and a threat to democracy. And now, post assassination attempt, the fact they got to tone that down gets rid of some of the edge that they had in terms of what their strategy was. So I guess you could build a view, and maybe the stock market is thinking about that, because there's no doubt that a Trump presidency is much better for the stock market, just by virtue of the fact that a lot of those tax cuts that were implemented under Trump won't sunset under Trump, but a lot of that tax relief will sunset under Biden. And of course, Trump also wants to cut corporate taxes. There's offsets from tariff increases, but it's not as if Biden has to raise tariffs. So I tie it more into a market call for November the 5th, that it raises the probability that you might even get a clean sweep. So it's more politics than economics, more how that plays into the markets. Not as if the stock market hasn't done well under Biden. I think we tend to give presidents too much credit and too much blame. But the stock market, we know what it did under Trump, that's for sure. And we know what the policies are going to be post-November. And I think everybody is just, as you look at the balance of probabilities, of the view that Trump is just basically risk on. So I would say that probably more bullish for the stock market if he wins at the margin, depending on what the circumstances are back then, how much more of the Fed rate hikes percolate through. You asked me about the economy. Well, I say that what you see is what you get. And this isn't so much about the election. It's more about, what does the U.S. economy look like when there's no distortions? Because since COVID, we've had just one distortion after another. We had COVID, and of course, we had the variants on top of that. Then we have the reopening, coupled with the massive gobs of monetary and fiscal stimulus. And then, of course, we have those massive stimulus checks that wasn't like the Energizer Bunny. It was a gift that kept on giving. I mean, a $2 trillion lottery ticket from Uncle Sam to the proletariat. And that had an impact on the economy right through 2023, because you can't possibly spend $2 trillion all at once. So we had tremendous fiscal stimulus. We had those stimulus checks. We had all the gyrations around the pandemic, the lockdowns, the reopening. There was just so much noise and so much volatility in the data, so many gyrations. And then, of course, we had the Fed going from, super easy to super tight. I mean, all we ever had was in the tightening cycle in 2022, 2023 was Powell comparing himself to Paul Volcker. We know how that turned out back in the early 80s. But right now we're seeing what the economy looks like without distortions. And what happened was that the Fed went through, a 500 basis point reset of interest rates is no small deal in an economy that is more credit sensitive than it's ever been in the past. And the impact of those interest rate increases last year got camouflaged by all the fiscal stimulus that we had in the system, and the last leg of that excess savings file being put to work in the consumer sector. That's all the rearview mirror. But we are still seeing the lags of the damage of what the Fed has done from March of 2022 through to July of 2023. And it was a massive tightening cycle. And the lags are still percolating, but there's no offset. So all of a sudden, what appeared to be a nice, glowy 3% real growth rate in the economy last year, we're barely above 1% right now. So you could argue that it's not a technical recession, but it looks like this is the sort of intense slowdown you get ahead of a recession. And when I started on the business back in 1987, whenever economic growth slipped towards a 1% annual rate, which basically is where we are in the first half of the year, I would always get the questions, when's the recession starting? So the big anomaly is that everybody and their mother have thrown the recession call into the waste paper basket because, of course, if it didn't come, it's never going to come. It's like me sitting on my perch in Toronto and saying, well, it didn't snow in December, so therefore winter's been called off. So my main message is that delayed is not derailed. And I think that what you see is what you get. And of course, it might not be reflected in the stock market right now because it's really focused on a bunch of other things. But the economy is weakening precipitously and minuscule growth right now. This is the weakest part of the cycle that we've seen really since the peak of the pandemic and all the anxiety. Of course, we went through a major contraction then with the economy locked down, but things are pretty soft, and I don't see what the catalyst is going to be to cause a reacceleration over the course of the next several months or quarters.
Do you think it's just going to be a matter of the new earnings reports coming out? I mean, when do people start to lose their confidence? You know, I think of we have unemployment. I mean, I see the government, pumping jobs, and despite, their full-time postings that seem to be changing or sort of manipulating the jobs numbers. I mean, at what point do these corporations that have shareholders that they're, really concerned about, making them happy, at what point do we start to see the emergence of the new earnings reports showing, negative numbers versus when they start making job cuts?
Well, there's a lot to unpack there, but let's just say that the economy is not the stock market, and the stock market is not the economy. There's no ticker in the S&P 500 called GDP, and but it is the economy that generates the earnings. And you hear all the time about this is an earnings-driven bull market. At one point, that was true, but that was a few years ago. If this was an earnings-driven stock market on its own, then the S&P 500 would be around 4,800 right now instead of 5,600 and change. Earnings are up, call it 8% year over year. The consensus is for earnings growth for the coming quarter to be 8%. But if we were up 8%, if it was all earnings, we'd be at 4,800 on the S&P. We're up 8%, but the stock market is up more like 25%. So it's really been 1 part earnings to 3 parts multiple expansion. And the multiple expansion in the stock market has nothing to do with the economy. That is all about what John Maynard Keynes famously labeled animal spirits. It's about confidence. It's about expectations. It's about hopes. It's about speculation. So what's happened is you've had the price earnings multiple on a forward basis is now flirting with 22. This is the top 10% priciest stock market of all time. We're in the top decile. And so it's reflecting something about investors' expectations of the future. And so what is that all about? Well, up until just very recently with this rotation to the value trade, which I really look more as a trade than a trend, the whole story has been AI, generative AI, the GPU craze kicked off by NVIDIA, but of course affecting other companies in the tech space to the point when you look at what we used to call TMT, which was technology, media, telecom, really tech and telecom today account for 40% of the S&P 500, which, by the way, is the same concentration we had back in 1999 and 2000. But what is the market telling you? The market is telling you something that has zero to do with today's economic situation, nothing to do with even tomorrow's economic situation. Remembering that the stock market is a long duration animal. We did this work going back the past century, and we looked at scrolled, rolling 5-year averages of the prevailing forward multiple on a 5-year basis. And what we tried to do was figure out what is the stock market telling us about the next 5 years in terms of predicting or trying to predict average annual earnings growth for the next 5 years. So historically, the stock market prices in, and there's variability around this, but on an average annual basis, if you're willing to look out 5 years, at any moment in time, the norm is that the stock market is discounting 8% growth in earnings per share on a 5-year basis. We just talked about on a year-over-year, it's 8% right now. So the 5-year historically is 8%. However, under current valuations, what is the stock market telling you it anticipates in terms of average annual earnings per share growth in the next 5 years? And what's the answer to that? The answer is 17%. 17%, more than double the historical norm. And the last time we had 5-year earnings growth expectations embedded in stock market valuations this high was, guess when? The late
For the
90s.
crash.
The late 90s. So I guess that I tell people, hey, I have my own particular view of the stock market, and everybody's entitled to their own opinions. But I try and instill some sanity into my customer base by saying, if you're buying the stock market today, then please have a forecast of your own in the next 5 years that earnings will accelerate, that the power of AI will be so immense that this is going to be such a productivity game changer that the trend in profits in the next half decade is going to be more than double what it's been in the past. If you have that view, buy the market. If you don't, caveat emptor.
Yeah.
And that's how I approach it.
So what do you think?
Well, I line up on the side that being a disciple of Bob Farrell, the Dean of Research at Merrill Lynch, that markets tend to return to the mean over time. That's rule number one. But also that there are no new eras and excesses are never permanent. And we saw that what was bigger for productivity in the economy, generally speaking, and globally, than the internet back in the mid-1990s. And the internet was real. You had, it wasn't just dot-coms. People called it the dot-com bubble. Everything that was technology got caught up in that bubble. Cisco Systems was the NVIDIA of the day. You could argue it didn't have the same dominant market position, in circuits and telecom equipment and so on and so forth, and in routers. However, it was the leader. You had Microsoft, you had Intel, you had Dell. You had a lot of tech bellwethers that bona fide business plans that are still around today. And even their stocks got clobbered for 3 years. And then they were in the penalty box for at least another 5 years. I'm not even sure if Cisco is back to that pre-bubble peak, but everything got caught up in it. They call it a dot-com bubble. And they talk about pets.com, companies with no earnings and infinite valuations and no business model, but everything was caught up in that. Like everything is caught up in it today. Even utilities are caught up in it. And some of the basic materials, of course, because you need silver and you need copper and you need electrical utilities and so on and so forth. So I think that I think generative AI is probably going to be it is a disruptor. I think that it is going to be a productivity game changer over time. It's not as big as the internet, but it's certainly bigger than 3D technology. There's just a lot of unknowns, a lot of assumptions about what the total addressable market is going to be, the TAM. I think there's probably too much priced in, and that's just based on my sense of history. There's still a lot of unknowns, but this is what the markets do. The markets shoot first and then ask the questions later. And we've seen that in the past. So I would say that looking at market sentiment, looking at the enthusiasm, looking at the market concentration, looking at the valuations, this seems to be a price bubble. I wouldn't say as big as it was in the late 90s, but this is a price bubble. The impact on the real economy is going to be real. But I think the markets, as is usually the case, they overinflate their expectations. It goes in both directions. Look, back in March of 2009, when the S&P 500 got down to that devilish low of 666, all the banks in the United States were priced for zero. At 666, they were priced for zero. Did we get zero? No. And at those depression lows in March of 2009, the market way overpriced the demise of the financial system. And right now, I think that the markets are dramatically overstating the impact that AI is going to have on corporate earnings. Not that there won't be an impact, but I don't think it's going to be I don't think it's worthy of the valuations that we have on our hands right now.
I hope you're enjoying the show so far. I just wanted to let you know that this episode is brought to you by our very own SachsRealty.com. If you're looking to buy, rent, or lease in the state of Maryland, well, hopefully we're your number one choice. But if you're anywhere else in the country, simply go to SachsRealty.com, scroll down to the map of the United States, click on your state and city to find a professional near you. Should you not find somebody in your city, as this referral program is brand new for us, please send me an email personally and I will do my best to connect you with someone that I trust. Now back to the show. Do you think, and in speaking to a lot of analysts, there's kind of like a mixed bag on the impact that AI will have on our jobs market. I was just watching a Volvo commercial that was 100% AI. I don't know if you've seen it, but it's brand new. It was 100% AI generated. I'm just using this as an example. And they were able to produce this commercial within 24 hours. So I know ad agencies, I know people that are working at ad agencies and own them. And the amount that a Volvo would pay for a ad spot is in the hundreds of thousands of dollars for a 30-second ad. And we're talking about something that was 100% AI generated. It's amazing. And, when you look at something like that, you say, well, what will happen to these jobs? So when we're talking about, investors baking in or companies baking in, future revenues on something or waiting, something like AI, and it potentially being in a bubble, what about all of the implications that this could create with jobs and earnings?
Well, look, earnings are one thing. Don't forget that jobs are a double-edged sword. Jobs are a cost of doing business.
But if people aren't buying products, they're
right, and correct, and they also generate income. But I'm saying it's a double-edged sword because there's a historically very tight link between profit margins and productivity. And productivity doesn't have to necessarily mean lower jobs, but it means that you're producing more per hour worked by definition. There's going to be
or machine eliminating jobs.
There's going to be job destruction, and there's going to be job creation in other industries because if it does what it's supposed to do, and if it's a productivity generator, then what does productivity generate? What is it about productivity that we like? It generates income. So then people have more income to spend and they'll spend it on other things. So it's going to be a shift in employment. It's no different. I mean, technology, we can go back thousands of years. Technology doesn't stop. And then, of course, you get inflection points. You could say generative AI is an inflection point in the technology curve. We could go back to, transistors, and we can go back to microchips. We can go back to the personal computer. Look, 30 years ago, you walked around there, you go to a bank, there are bank tellers everywhere. Where are the bank tellers today? Now who before the 1990s, who we had, so now we have, Instabanks, and then we have, digital money. And so we're putting a lot of middlemen and wholesalers out. What was the teller after all? Really just a middleman, middle woman. Now you just go straight to put your card in the bank machine and you get your cash out, or you make a deposit. You could do a whole bunch of things that you had to use as a teller before. And the unemployment rate's 4%. Where are those tellers gone? A century ago, the biggest source of employment, when you go back to the early 1900s, was what? Was agriculture. There's probably not a sector that's undergone more productivity improvement than agriculture. That used to be the predominant source of employment. Then after that, when you go into the 1930s, what was the biggest source of employment? Was something called domestic services. A more politically correct way of saying housekeepers. Okay, that was domestic services. And of course, for the high middle class, the upper class, they had many servants, maids. That was the principal source of employment. And you know what destroyed that? Do you know what destroyed that? The vacuum cleaner.
Okay. All right.
So that's why, like,
Yeah.
it was called the Hoover recession for a
Okay.
reason.
All right.
So in any event, of course, then you had, I mean, what were you going to say? Oh, the washing machine and the dryer that's going to put other people out of work. They used to have people bring your milk to your door.
That's
Oh,
true.
the next thing you know, well, we have a refrigerator. Don't need to have them come around anymore. So where did that job go? So, you hear, I mean, this is where I put I guess my optimistic hat on, is that it just shows that it is a dynamic economy evolving over time, especially when it comes to technology. Technology is just a loose term. They talk about, electric vehicles, but I mean, the car turned into a computer, 20 years ago. So yeah, I hear what you're saying. I said earlier that generative AI is going to be disruptive, but the internet was disruptive, and there's going to be winners and losers. And then, you have to, I guess, encourage your kids to focus their attention on, where the employment prospects are going to be brightest. But the important thing that you have to realize, I think, is what the productivity, if we get the big productivity gains, and this happened with the, with the internet. Remember that it brought in tremendous corporate revenues that brought in turn, massive tax receipts to Uncle Sam. If you remember back in the late 90s and in 2000, and this is what George W. Bush inherited, a surplus, and it wasn't from anything really that Bill Clinton did, but the internet, by generating so much massive income, brought in the government huge revenues that they in turn could use to cut taxes. Well, that puts money in people's pockets. People then will go spend that money. So where those people spend that money that a generative AI generates, where they spend that money is going to create employment opportunities in those areas that people got displaced because of AI. And that's why it's an ongoing evolution and dynamic environment. And I think that's how things are going to play out.
Yeah, and I hope you're right. I mean, I just look at it as I think about, I've been in construction my entire life. So I've been a blue collar worker. I mean, I built things with my hands and built houses and have been a contractor, builder for 35 years. But I think we're not teaching people that anymore. And then I look at, since the 1970s when we started really offshoring, we watched our wage growth really not keep up with inflation through the years. And, I look at that there's a bigger divide now between the haves and have-nots and, the middle class. I mean, everybody is struggling financially if you're not in the top income earners. I know our clients that are buying houses. I mean, they are, especially the ones over the last 4 years, these are young people with good paying jobs. They need both incomes to make the mortgage payment, and they're feeling it really badly. And I think that, I just think of, where will they go? What will they do? What will those new jobs be that where we're a country that doesn't make anything? When we're a tech country, essentially, that can be, those jobs, white collar jobs are just at a risk. So I think, when I look at it from just a practical approach of being an entrepreneur for 35 years, I just look at it and say, look, I've never seen things. And maybe it's just, some people are like, oh, you're just another old guy that, you've had great opportunities your entire life. Yes, I have. But I'm really concerned for my kids and their kids and their kids' kids and where we're headed with this thing. So the stock market could be overvalued. It could be a bad time to get into it. Back before the GFC, the global financial crisis, in our industry, real estate, we watched as the stock market started stripping away wealth. People panicked and they took their money out and invested in real estate. And what did that do? That fueled the then real estate bubble for people investing in real estate that had no business doing that. And then, of course, we watched the bubble burst with the housing market. And then these investors got a double whammy, right? They lost in the stock market. They were devastated in the housing market. if we see some kind of a dip now in stocks where consumer confidence and people start pulling their money out, where will they put it? Will they uh, push this real estate bubble even higher? Or do you see, I mean, where will they put their money?
Well, no, I don't think that, assuming that rationality comes back into play. And I say that because the basic math does not support where the stock market is right now. It is a lot of euphoria and animal spirits. It's really primarily a multiple driven market. And this is what we know about the markets. The two most extreme emotions, fear and greed, the primal emotions. And right now we are in maximum greed right now. And so if, say, we do the Bob Farrell mean reversion and something happens that causes the multiple to contract, or if we start getting earnings disappointments, remember that the NASDAQ, which really is the poster child for tech companies, it peaked in February, March of 2000. The recession started a year later. The Fed was already done tightening monetary policy. That happened because we started getting some disappointments in the tech earnings. Cisco, God forbid, missing by a penny for the first time in a long time. But you started hearing orders being canceled, and people started figuring it out that that we've paid too much for all these fiber optics and routers and circuit breakers, and everything was going to go into building the World Wide Web. It was a much bigger financial bubble than it was an economic bubble. In fact, we had the stock market go down 60%. GDP went down like 0.3. That's what I said before, that GDP and the stock market aren't necessarily the same thing, but you had massive multiple contraction and mean reversion. I see something playing out like that this time around. And just remember that it wasn't about the recession back then. It was about earnings disappointments. I think the economy is going to be struggling. I think that there's going to be something out there and a disappointment that is going to cause the price earnings multiple to mean revert. And I say that because, as per Bob Farrell's rule number 1, it is a mean reverting series. And God forbid, you don't even need an earnings recession. You just get something that causes the P multiple to go from almost 22 to call it something closer to 17, a 5-point multiple contraction alone will generate a bear market in equities. Now, your question about, well, will that money then filter through into real estate? Not so fast. Not so fast. And I'll tell you why. What is the one thing that you need the most when the stock market goes into a bear market? What is the one thing investors will need? It's like a water to somebody dying of thirst in the Sahara Desert. What is it investors need in a bear market? In one word or less, liquidity.
Yeah.
So you're not taking that money and putting it in the real estate market, which is a lot less liquid than the equity market is. You'll move it into cash and you'll stay put. And don't forget that real estate and equities, they're highly correlated. They are highly correlated, long duration, cyclical assets, and they move together. Yes, you're right. We had a real estate meltdown in the great financial crisis, but we also had an equity meltdown. And when equities went down, the money didn't go into real estate. And when real estate melted down, it didn't go into equities. And you go back to that other period. Wasn't nearly as bad, mind you, but the late 1980s. It wasn't just commercial real estate. The housing market went down significantly, and so did the stock market. Not a huge bear market in equities back then. It was 20% peak to trough decline. But you'll tend to find that equities and real estate, being highly correlated, move up and down together over time. So no, you don't want to have that view that, okay, I'm going to do a shift from one risk-on asset to another risk-on asset. You want to build liquidity. In fact, you probably want to start doing that now, because inevitably, and bear markets are inevitable, recessions are inevitable. Thankfully, bear markets are short, recessions are short, bull markets are long, and expansions are long. But the problem with bear markets is that if you're not prepared, you can get wiped out. And so that's what I'm saying. It's the analogy is that a bull market is a escalator going up, and an elevator, and a bear market is an elevator going down. So, and then of course we know that fear is a much more primal emotion than greed is, and we're living with that other excess emotion, greed, right now. Gordon Gekko, greed is good until the pendulum swings the other way. But what's going to happen, I think, is that people will move towards liquidity, which means they'll be moving into cash and moving into bonds.
What are the chances? So, I mean, you know, uh, I hear people talking about buying gold and silver, and let's just take it from a cash standpoint, or a cash approach. So, let's say the securities markets start failing, and people are wanting to do something, go to cash, whatever, sell off. Real estate market, let's just say they did learn their lesson, or they can take a look back in history and say, yeah, that wasn't really good, because real estate prices can crash, home prices can crash. They learned that in '08, or through that period of time. But now throw the dollar element into the mix and say, can that collapse? I mean, I listen to people that say that the dollar's in trouble, our debt, nobody wants to buy our debt anymore. I think about the stock market as being, or the U.S. securities markets being, traded in dollars. I think about the dollar being the world reserve currency. But then I also hear about the BRICS nations, and how these countries are trying to find ways to not trade in U.S. dollars. So is there potentially a perfect storm that's coming, where we see securities fail, the housing market fail, and the dollar collapse at the same time?
Well, I have a tough time with the dollar collapse story. I mean, these global central banks, of course, are all focused on what happened post Russia and the freezing of their reserve assets. And then you have these other rogue states. Could that happen to me? So we have to dramatically, reduce our dollar reserves. And that's why central banks like the People's Bank of China have been loading up on gold, so on and so forth. I'll tell you the truth. To me, that's really small potatoes in the overall scheme of things. I remember in 1999, the advent of the euro. And the new kid on the block, the euro, and the IPO was 119. Words of today, like 108. And that was supposed to supplant the euro. The euro was supposed to supplant the US dollar, or compete with it as a reserve currency. Didn't happen. It didn't happen primarily because you had a region that was a little dysfunctional, where you had a common currency but not a common fiscal union. The United States has both. It's a monetary union and a fiscal union with a constitution and property rights. And for all the warts and blemishes, it's the cleanest and most trustworthy shirt in the laundry basket, because a currency, an exchange rate, is a relative trade. It's a pair trade. So when you talk about the US dollar collapsing, collapse against what? Collapse against what? The Japanese look like they're scared of their own shadow with the dollar yen at 150. It's interesting. Is the US dollar going to collapse against the euro now that it's just fractured? I mean, we can argue about US politics, but we'll get an answer November the 5th. The US will have a president. The US will have maybe checks and balances. We'll see how the Senate and the House go. But look what's happening in France. Look what's happening in Germany. I guess you could say that, the UK has a semblance of stability. With the Labour Party, I don't know how much confidence that really instills. And then we still have the memory of all those bailouts of Portugal and Italy and Greece and Spain. Those are the countries actually right now doing the best in Europe from an economic perspective. They all got bailed out. So, what's the U.S. dollar going to go down against? And it doesn't mean that the U.S. dollar doesn't go into bull markets and bear markets like everything else. But when I hear about the dollar collapse, I'm not convinced. I mean, everybody in the world has various levels of debt and deficit problems. We're all in this together. Of course, we're so myopically focused on the U.S. However, everybody shares different levels of fiscal recklessness. We're all in this together globally. The US dollar, in the sort of markets you and I are depicting, where it's risk off and there is a shift towards liquidity preference, I've got news for you. The US dollar is going to go up, not down. When people get nervous, they flock to the US dollar. Now, maybe this time around, they'll have to hold their nose and flock to the US dollar. But I'm not even going to say in a crisis, in bear markets, you naturally go to what you think is safest. And I don't think that notwithstanding what the BRICS central banks are doing and these rogue countries, the general global investor base will shift towards US dollars in a bear market. And I say that because it's practically always happened, and I don't believe in ever saying it's going to be different this time. There's a reason why that happens. It's liquidity preference, and there is nothing more liquid than the US dollar market.
What about the debt? Do you think the debt's a problem, or you think that how do we deal with the deficit? How do we deal with the overspending, and how do we ever come out of this without having some kind of hyperinflation?
Well, I don't even know. I don't think that the debt is inflationary, because if the debt was inflationary, you'd be having massive inflation in Japan for decades. And who's got more debt than Japan does as a share of GDP? No, it's actually what happens is that the debt ends up acting as a constraint on aggregate demand growth. And it is actually more disinflationary than inflationary. Now, it doesn't mean you don't get a sugar high. Let me give you an example. We had a nice sugar high with those tax cuts from Donald Trump. 2018, of course, it caused the Fed to have to raise rates 4 times, but it was a 1-year sugar high. Then things slowed down in 2019. Even before COVID and the lockdowns, the Fed cut rates 3 times. It was a sugar high. But the problems with the exorbitant debt to GDP ratios, which are now well over 100%, is that you get increasingly less stimulus in the economy from every dollar that the government tries to stimulate. It's basic economics 101, the law of diminishing returns, that too much of a good thing is actually not a good thing. So this is not the same debt ratios we had when they were 30% when Reagan came in with tax cuts in the mid-1980s. This is a totally different kettle of fish. The debt albatross is a tourniquet on aggregate demand growth. It's a constraint. I look at it far differently. I think it actually is going to it's going to be a hamstringing development for future governments to stimulate. If we had a 30% debt GDP ratio, we would have a ton of runway to stimulate fiscal policy. We don't have that anymore. And we don't have that anymore because what's crowding out future spending or stimulus, and we'll see how far either party could go, including Donald Trump, on fiscal stimulus at these debt levels. It's not going to be that easy because interest payments are crowding out a lot of other things the government can do. And now interest payments, which are even larger than what we're spending on the Pentagon, and we know that's going to have to go up given what's happening around the world. And then you have all the entitlement programs. But what's left over? What's left over? Not much. So it's actually the debt is a constraint on demand. And if you're going to forecast inflation, you better have a forecast for demand. This is actually a dead weight drag on future demand growth. I view the debt burden as being disinflationary, not inflationary. And when does it become a crisis? Well, it's like what you want to follow when you're looking at companies. You're a credit investor looking at companies in the S&P 500. Or you're looking across, investment grade, high yield, and you're looking at really one thing. You're looking at interest coverage ratios. You look at interest coverage. That's the most important ratio. So you look at debt equity, you look at interest coverage. And of course, in the US, the debt equity ratio was to the moon. And the interest coverage, which I refer to as interest payments, what percentage of revenues are being siphoned off by debt service costs? That number's up to 15%. It's doubled just in the past couple of years. I'd say that when do we start getting to a situation where this triggers a real loss of confidence in the dollar, as you said before, or a situation where we have a series of tailed auctions, or God forbid, a failed auction, like what happened in Canada in 1994. There was a failed auction that precipitated the crisis that Canada endured, and then forced the government of the day into action. A lot of tough fiscal measures. That's what stares America in the face. It hasn't happened yet. When you get towards 30% of interest to revenue ratio, that's the big problem. And I've written about this, when we cross 25%, and it could be a couple of years from now, I'll be ringing the alarm bell. We're not there yet, but the trend is definitely not your friend, and it's worth noting and having on your radar screen. But when that interest expense to revenue ratio for any government approaches 30%, look out. By the way, the strategy there will be to go long as much gold as you can probably stomach.
What would you do if you were in charge? I mean, what would you do in front of this to prevent that? What type of fiscal measurements would you take, and to endure some of that pain now versus letting it get that far?
Yeah, well, this is human nature. The conservative government in Canada in the 1980s under Brian Mulroney tried desperately to embark on fundamental fiscal reforms that included entitlements. And it wasn't only until the crisis started a decade later that the population would accept those tough measures.
Eliminating the entitlements.
That's look, it's like you build the stop signs after the four-way car crash, right? It's just human nature. What I would do is I'd want to roll back the clock to George W. when he tried to privatize or partially privatize Social Security. God forbid. I think that this happened in Canada, which is viewed by most Americans as a quasi-socialist European-type country. We went through dramatic entitlement reform. You have to raise retirement age for benefits. You've got to means test based on income. You got to means test your the level of receipts you're going to get from Social Security. A whole bunch of different measures. It has to be extremely progressive. But we have to means test Social Security and raise contribution levels, which is a tax increase by any other name. But you ask me how you get out of this morass. You're not going to be able to do it so much by cutting discretionary spending, because after military, there's not a whole lot you can cut anymore. Yeah. So what I would do, and you got to get buy-in. And Americans, just like Canadians in the 80s, Americans, they want their cake and they want to eat it too. Everybody wants the candy, but they don't want to pay for it. But the biggest problem, right now, interest expense is a big problem. As the Fed eases and yields come down, it'll become less of a problem. However, the really big issue is entitlements. And just think of that word. Entitlements. Entitled to what? What are you entitled to? So this is the problem, is that the government, and this is why, America, I'm Canadian. I look at America, it is a powerhouse, really the best economy, I think the best political system in the world. But what is with this entitlement? How can you be a capitalist country and have entitlements? And
that is the question.
And entitlements at every level of income strata. So look, the thing is that if you made a certain income in Canada, sorry, I know, yes, we promised you these benefits, but we can't afford them anymore. And guess what? There was no revolution in Canada. We accepted it. It's called shared sacrifice. And I find it very interesting that when you go to the baseball games, and every single baseball game and even hockey games, they'll have someone in the military who has served or is serving get up and to a rousing ovation, we applaud the military, as we should, doing service. Yes, those people who are in the military know a thing or two about shared sacrifice, but all those people applauding don't know the first thing about it. So I guess that's why I would never be elected, is because I would have to just I'd have to just say the painful truth. We cannot afford the social contract. We have to break it. If you don't like it, guess what? You can't sue me. I'd find a new word for entitlements. Okay. Entitlements to me is like, what is that? Welfare for all. We have to attack Medicare. And once again, in terms of not so much the disbursements, but I guess that, how you deal with drug prices is very important because the government's ensuring that. And I'm not going to go on a tirade about big pharma. But I would say that what has to happen in the United States, if you're not going to have a tax system that's even more progressive, and it is progressive, but probably has to become more progressive, then it has to be really progressive when it comes to the entitlements, because that's the biggest source of expenditure now and in the future when you look at the demographics. So I think we have to attack principally Social Security. But you look at the debates, and the one thing the Democrats will point to the Republicans and say, "Oh, he's going to attack Social Security." It's like we're back in the 1930s again. I mean, all this stuff was brought in and then expanded in the Great Depression. We simply can't afford it. Just small changes to contribution rates, small changes to means testing, Social Security by income cohort, raising the retirement age because we're all living longer. That's just smart fiscal policy, but politicians are too scared to do it because they know that they won't get voted in. You just have to take a look. The template was, George W. was already in power. He couldn't even get, and those were great ideas that he had. Those were transformational ideas that he had on partially privatizing Social Security. Couldn't get it through Congress. So I think that's the big problem. But I would say that's what I would do first, is I would attack entitlements, and the first thing I would do was I would change it with a different word.
Yeah, I think about what you were saying with the Medicare and Medicaid and Social Security. I think about it as, from an employer, that's a big number. It's 7.65%. And I hear you. I mean, there's always the question: do you raise it? They've been raising. I think it's at 90,000 now that that you contribute up until an employee reaches over that financial threshold. But you're getting 7.65% from the employer. You're getting 7.65% from the employee. The way I look at it, that's almost 16% that essentially they're not collecting, right? They're not getting in their pay, is going into this. I don't want to call it a black hole, but I'm just going to say that it's amazing when I look at, I would like to see the accounting on that side of things, to see, how that money is spent, where it's being spent, how it's being distributed. Is it really going, into what it was originally intended for? How efficiency is the, are the departments within the Social Security Administration, as far as, are they, firing on all cylinders as far as, being the most efficient and proficient establishment, if you will. But as somebody that's dealing with this now, with an aging parent, I'm looking at that's not enough. If you're depending on, we're sold this bill of goods that this is great for us to invest in, but to be honest with you, you need supplemental care, you need advocacy. You need to fight to get what you need when you get older in life. God forbid you need to depend on Social Security, Medicare, and Medicaid, for your aging. But I look at it as, you talk about entitlements. I couldn't agree more. I mean, here in the U.S., we're forgiving student debt. We're allowing these kids to rack up college debt. A lot of them have never graduated. They signed a dotted line. They dropped out of school. A lot of people paid their student debt, and they're like, wait a minute. Why am I paying my student debt and they're not paying their student debt? And then on the flip side of it, we have this mortgage, kicking the can down the road. We allowed, interest rates to be lower than ever, for the 30-year fixed rate mortgage. I mean, it was ridiculous. They're almost paying people to buy houses, and allowed the asset prices to go up. Now people are defaulting. We're not allowing them to, face the music of their default. And, so now we're going through, just, billions of dollars in, forbearance, American Rescue Act, which I get it. Look, it's way above my pay grade. But when we look at it and we go, okay, we're allowing certain special interest groups, if you will, to, profit on the systems. And, no one is standing up and saying, look, we need some kind of reform. And, and I don't know. I mean, that's just David, that's a rant from somebody who's frustrated in watching things, unfold for Americans and the lack of affordability. And then, like you said, the entitlements, they're vote buying measures is what they are.
Yeah. Look, I think that the student debt relief is totally irresponsible. And you can't really justify it. You can't justify it. And you're 100% right. The money doesn't grow on trees. And we're going to subsidize student debtors who, if you look at the life expectancy table, they're going to live another 60 to 70 years. They have a long runway. And then you've got this aging population that are going to need medical needs. So, what are you thinking as a fiscal policymaker? Why are we basically subsidizing people in their early 20s when we have this demographic time bomb in this aging boomer population that's going to need more medical needs? We should be really treating fiscal policy like the piggy bank and cherishing it and nurturing it as opposed to jeopardizing it. I think that is, you're 100% right. I'll just tell you right now that we know what Donald Trump is going to want to do. I don't think that I'd rather wait for the AI boom to generate the revenues if they come to, and then cut taxes, than cut taxes in this fiscal environment. I think that's not something I would do, but the stock market sure loves that premise. But at the same time, we can't afford the government spending that's going on, and I think that the Joe Biden fiscal policy has been a train wreck. I mean, we $2 trillion of stimulus checks, and as the economy, I mean, Pfizer Monday was in November 2020, and $2 trillion of stimulus checks after the economy reopened in March of 2021. Nobody cares. Nobody cares. Everybody, but I guess that's the thing. Everybody wants the candy.
Yeah, if you're getting a check. I mean, and that's what people don't realize. And this is the most frustrating part. We are in worse shape I think the stimulus is the only thing that defies gravity. I mean, it goes straight up to the coffers of the wealthy. If you look at it and you say, okay, we helicoptered money to America and I get it. No one knew what, the future was going to hold, through the pandemic. Our business saw a complete boom. I mean, I saw people in my industry, getting PPP money in a time where we're making more money than we ever have. It's like, what? How are we managing that? But now when we look back and we go, okay, we printed more money in 2 years than we did in 200 years. Where did it go? we're, over 1.2 trillion dollars in consumer debt, of very expensive consumer debt, by the way, credit card debt at high interest rates. People are in auto loans for 7 years. A lot of them are in default. We forgave all of this debt. It's like, what does this make sense? I mean, where am I? What am I missing here? Yet and no one wants to face. No one wants to talk about it. I sit around and I go, where the heck is our leadership here? It just amazes me.
Well, what the politicians are doing, and they're just following what the population wants, right? You're going to vote Democrat, you want big spending. You're going to vote Trump, you want big tax cuts. The whole thing, the tax cuts, part of them on the personal side are supposed to sunset. They were never supposed to be permanent. So there's a sunset clause, but they're not allowed to sunset. Now the big fear is, oh my God, if Biden gets elected, then a good chunk of this is going to get sunsetted. But of course, he'll make up for it with more spending. It doesn't matter. If you noticed, Donald Trump, he's got a 16-page platform. He's taken fiscal policy, which, the mantelpiece of the Republican Party, conservative Republican Party, was always about fiscal probity. And that's been taken out because we know that Donald Trump is not a fiscal conservative. We certainly know the Democrats are not fiscal conservatives. And the politicians want to get reelected. So, and the population, I'm assuming that they're smart, but I guess you could be smart and still want freebies. You could be smart. I still want the candy. But the thing is that I want the candy. But here's the thing. You're right. It's as Herb Stein famously said, anything that can't last forever, by definition, will not. And what the politicians are doing, cycle after cycle, is they are testing the outer limits of deficit finance. And if we continue to go down this road, and I said before, if we start getting the interest coverage ratio in the government sector up to 30%, a lot of bad things are going to happen. And then what's going to happen is that we will get shocked. We will get shocked into a fiscal crisis. Do you think these, now the US being the reserve currency, being the strongest economy in the world, debt has brought down other military and economic powerhouses in the past. You can go back thousands of years. Excessive debt brings down these empires. Nobody, I'm sure, 200 years ago thought the British Empire would not be the British Empire anymore. When they used to sing Britannia rules the waves. People don't know their history. So that's the problem, is that the debt is a jeopardizing force. And I think that politicians believe that they have a carte blanche to continue. And now we don't have any party, except maybe RFK Jr., but he's not really, doesn't have a shot. They don't even let him on the debates. There's nobody as the flag bearer for fiscal responsibility anymore. And that's really what I'm getting out of this election more than anything else, is I'm getting a sense that that fiscal responsibility is not a political winner. Therefore, nobody's going to campaign on it. And there probably will be a time. And I said before, what I'm watching the interest expense to revenue ratio. And if we get towards 30%, and the way it's going, it could happen in a couple of years, then we can talk more about that dollar crash. We could talk about where will investors go. I said before, other countries are following a similar fate. Well, there is your bull call for gold, and probably gold and silver right there. But we're in a slippery slope. I totally agree with you. And the deficit is becoming increasingly structural. It wasn't. Reagan was taking top marginal rates from like 80, 90%. But back when the debt ratio was 30%, there was huge multiplier impacts. Totally different kettle of fish. So look, I'll just say right now, no, I don't support tax cuts right now. And I would put a freeze on all discretionary spending, an outright freeze right here, right now. And I would means test Social Security in particular. I would go through a massive overhaul of entitlements. but you have to educate the public as to, why, that's how we, if I was a politician and I had power, that's what I would do. I'd have to treat the electorate like a child and say, this is why you cannot have your third piece of chocolate cake. It's not good for you.
Makes sense. What do you tell, as we kind of wind down here, what do you tell young people nowadays? It's interesting because I serve a lot of young home buyers, and many of them feel that they are really they're handed a bag of crap from the Gen Xers and the baby boomers, and from the wealth building that the prosperity that we've had here in the U.S. for the last 40, 50 years. And they feel like they don't have the same opportunities. Maybe some of this is just them not being, taught right or being babied. I'm not, saying that, that's the case with everyone, but what do you tell people when they are riddled with student debt because colleges are so expensive, and not that it's forgiven, but they took on this debt. They're trying to get jobs to pay the bills. They're looking at rents that they don't make sense. You're looking at 30-year-olds that need roommates. I mean, geez, when I was in my 20s, I lived on my own. And you what do you tell these people? How regardless of what happens on the political front, or the stock market or the economy, or what advice do you have for someone that is just starting out?
Well, I don't know if my advice really changes that much over time. I think what I would tell a young person is, and let's say are you talking about a young person in school or a young person out of school?
Yeah, just somebody starting their career, someone, that's graduated, that's trying to make a difference, an impact, that's surrounded with a lot of struggle.
Well, the most important thing is to impress your boss and your bosses. So I say just work your tail off and become as indispensable as possible. And make sure that you network as much as possible. And I don't mean network like in social media. I mean like face to face. So I think that, as Woody Allen said, 90% of life is showing up. So, be out there and network, work hard, and read. You know, read a book a week. And I'm not talking about TikTok and Instagram. Continue to educate yourself. I would say that embark on something a little different than your friends, called frugality. Save as much of your income as possible. And I'm not going to go into how you should invest it, although if you're a young person, you can be a lot more risk on than, say, I certainly will intend to do at my age. But I would say that there's no replacement for work ethic. Work and attitude, there's no replacement for that. That will all, whether we have debt, AI, a muddled political picture, a murky future, there is no replacement for an excellent work ethic and an excellent attitude. And how do you maximize your opportunities? Is you be out there, you make contacts, you expand your network. That could be something as easy as joining a wine club or a reading club. But I would say that you want to also be diversified. You don't want to be pigeonholed. And this is what I tell people right now who are engineers or computer science or financial wizardry. Everybody wants to be a coder. But you see, the one thing that AI is not going to replace is this. It will not replace creativity, and it will not replace original thought, which is why reading is so important. And it's why when I actually do my hiring and I'm looking at people, I'm looking at what are their outside interests? What are their outside activities? What is their passion beyond their work? And I tend to find that if you are heading into engineering or sciences, or where your dad and your mother are telling you you should carve out some into the arts and creativity. And that could be philosophy, it could be actual art, it could be English. AI is not going to, there's so much plagiarism out there. It's basically what AI has done is it's legalized plagiarism, but it cannot replace original thought and creativity and the ability to write brilliantly and to be a great oral communicator. I'd say those are the things, how you want to do self-improvement, all the above. And I would say this for everybody that's watching us is the one book that I've read in the past maybe 6-7 years that was a game changer for me was Thinking Fast and Slow by Daniel Kahneman. That is an absolute must read. And it caused me to do some introspection myself as to how I want to spend my time. Because that is, after all, our most precious resource. And that's what I would advise to the young people is, just as you and I will talk about how you want to reallocate the asset mix, well, think of time as your asset mix, especially as a young person. Think about how you want to allocate your time. And that'd be my advice to the young people on the show.
I think that's advice to everyone. I think that is fantastic and well said. Took so much out of that. I think, a lot of what you said went back to one of your original, points of advice was to be indispensable. And I think that is amazing. And you talk about that book. I read a book. I don't remember who the author was, but it's an older book. It's over 20 years old, but it's not, let's see if I can get this right. It's not the big that eats the small. It's the fast that eat the slow. And probably similar to the book that you mentioned, but wow, that's good stuff. And gosh, I can't thank you enough for your time. It was amazing. We covered a lot of ground, and I think that there is hope no matter what we go through here. And David, how can people stay in touch with you? I mean, I know you have Rosenberg Research. What can we do to help you?
Sure. Well, I run my own research company. So, and I basically forecast the economy and all aspects of it, and the financial markets, equities, bonds, the currencies. And we're primarily U.S. focused, but we span the whole world. So that's my stock and trade. Really connecting the dots between the macro and the markets, and then formulating a cogent and hopefully coherent investment strategy out of it. Because the name of the game is to take economics and make it relevant to how people can make money or save money. So that's the ethos of the firm. And how you can find me is you can just Google Rosenberg Research. It'll take you to the website. Or you can send in a request for a free trial of my research, everything that I do, either rosenbergresearch.com or information@rosenbergresearch.com. I have close to 3,000 clients in 40 countries. And it's been a wonderful experience. I've been doing it for over 4 years now, of course, after working for big banks my whole life. I finally took the plunge and set up my own shop. So the buck stops with me. You can come onto the website. You can just put in your credentials and get a 1-month free trial.
Yeah, we'll definitely publish everything below. And we thank you so much for your time. And I know you're very active on X, so I highly recommend people checking you out there as well. And sir, I look forward to hopefully doing this again with you real soon.
That'd be great. Thanks very much. And enjoy the rest of the summer.
Thanks so much. Thanks for watching and making it to the end. And if you like the video, you can let David and I know that you did by smashing that thumbs up. It'll actually help the algorithms push it out to more people. Drop your comments below as we like to read them. And if you haven't already subscribed to Sachs Realty's YouTube channel, what are you waiting for? Think about doing so right now. Hit that subscribe and the alert bell. You'll know every time we upload content. And one of the best compliments that you can give me here at Sachs Realty and your host of the podcast is to share this video and our channel with your family and friends. This will help us to build the most amazing community, hearing things that you don't hear on mainstream media about real estate, finance, and geopolitical issues that could be affecting you and our country. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.